Welcome to the Art of Money podcast with Art McPherson.
And thanks for checking out the Art of Money podcast. My name is Mark Owens alongside Art McPherson and Luke McCarty. All the information for the McPherson Financial Group, you can find it at theartofmoneyradio.com. I want you to meet a gentleman by the name of Luke Fedlam. He is a sports attorney who works with athletes from high school to college and to the pros. I want you to hear this clip. He talks about the mental toughness of Tom Brady.
You should be mentally tough when you're thinking about how you're spending your money. You should be mentally tough when you're thinking about how am I going to do good for my family and not set them up for challenging situation down the road. I need to be mentally tough when I'm thinking about ensuring that I have a team of advisors, financial advisor, agent, attorney, accountant, etc., who understand me and understand how to get me to where I want to go. I need to be mentally tough to stick to the budget that maybe my financial advisor put in place for me.
Art McPherson, Luke McCarty, what do you teach your clients about being mentally tough with their finances?
Well, that is a really good conversation there, that little snippet. So part of the struggles we see clients go through is maintaining a correct budget. So one of those big problems can be you have a spender and you have a saver, and the spender's winning the discussion, or the spender is the one that is in charge of the budget. That doesn't typically work very well because a spender wants the freedom that the money provides, but they're always the ones that will struggle with staying on task or staying on budget. You also have the saver that wants to see the accumulation, so they will almost do anything and everything and not pull any money that they could really use because they love to see the portfolio grow. So they like to see it grow, and they won't allow the spender to have enough money to be able to do the things they can easily do. So you have kind of two contrasts there. But basically it's making sure the spender is checked a little bit and the saver is checked a little bit too, so that there's a good happy medium.
The mental toughness from the budget side and the spending or not spending enough. There's also the mental toughness to go home after a meeting you have with us and really talk about long-term care, really talk about your estate plan, talk about the things you don't want to talk about because they're going to happen, right? We're all going to pass away. What happens to our assets? What's the easiest way for somebody to inherit them, whether it's a kid, a grandkid, a spouse, a friend, a charity? If you don't do it correctly, the court's going to decide that. And then, having the toughness to say, what if, if you and your spouse are sitting around talking, what if one of us need long-term care? How are we going to pay for that? Is our portfolio generating enough income to pay for that? What if you have a memory issue, right? What if you're in this and need this care for 10 or 15 years? We need to plan now. We need to have this conversation. We need to know what's going to happen if this potentially happens to us. So those conversations are always tough to have. It's always tough for us to bring them up because we have clients going through them. We know the statistics, but the mental toughness to just have that plan, even though you don't want to talk about it, is kind of what I would add to that, really fast talking snippet you added in there. from another Luke. Two Lukes talk fast, huh?
772-281-5223. We'll slow down the conversation when you call the team at the McPherson Financial Group and help you get mentally tough and ready for your retirement plans. And speaking of, we always dream about getting away from that 9-to-5 grind. But the question is, are we really prepared for the different phases of retirement? There was an article in Kiplinger that talks about those stages that change as you age. So, Art McPherson, when we talk about the phases of retirement, what are your thoughts?
Well, one of the things you have to remember is there's different stages. So one of the things that Luke and I get a very unique perspective on is we have clients right now that are at the end of stage. They are in an assisted care facility, or they have lost a spouse or a partner, and now they're living alone as a widow or a widower. We see the stages from pre-retirement, about that, what we call the retirement red zones, 5 years prior to your retirement date, and all the planning that we do with clients to prepare for the retirement day. And then we have everything throughout. So we can see, and we have our clients that are in all these stages, the pre-retirement stage, the retirement stage itself, the income distribution phase, and then how much average money is spent in those different phases. So our clients are going through this all the time. So Luke and I, and if you look at the way the firm is, we do probably about 100 rollovers a year, where most people, when they retire, they have to do that huge rollover on more money than they've ever had in their entire life. And that's their first phone call. So a lot of mistakes can be made. So we partner with our clients and we walk through those things, and we do all those complicated, heavy lifting issues for them so they don't have to worry about it.
Yeah. So there's the stage of pre-retirement or pre-retirement, like myself, where you're accumulating. So you need to just save as much as you can, invest it in the market, have a plan, reduce risk as you can, but, pretty much just kind of be aggressive and let the market do what it does, right? That's the accumulation phase in pre-retirement. And then there's the pre-retirement that Art spoke about, 5 years from retirement. But one thing we've noticed, and it's different from the industry standards, is that when a client first retires, you're going to spend more money than you think. You're going to spend more money than Vanguard says. You're going to spend more money than Schwab says, right? They all kind of say you're going to spend 60, 70% of your income. Well, not really. So we see the first 10 years of retirement, right? The go-go years, you're going to spend a lot more money, right? Then you're going to have the slow go where you spend less money because something's happened. There's an event, there's medical issues. And then you're going to have the no-go where you don't spend much on anything for fun, but you may be giving it away or you may be spending it on medical issues in your life. So there's kind of that curve where you spend more money at the beginning of retirement than most people think they do.
772-281-5223. Continued market correction fears have some investors wondering if it's time to sell off some of their portfolios. There was an article in Morningstar that says panic selling could undermine a plan's success. But tell me some of the reasons that maybe you should sell.
So panic selling is the reason why individual investors underperform the stock market. I think I've mentioned this before, where we get emotional with our money. We see it going down. We either sell it on our own or we call Luke and Art and say, hey, I want to sell. We had some clients do that the last couple of weeks, and we slowly talk them away from doing it. Historically, from a market perspective, the month of January, we were oversold more than we were in March of 2020. So it doesn't always mean a rebound's happening. It doesn't always mean selling is going to stop, but it pretty much means it's not a good time to sell.
And one of the things that we're trying to do is make sure our clients are not panicking, because if you panic, then you're reacting negatively and usually emotionally. So when you're investing, why are you investing? You're not investing for today. You're not investing for the end of this year. You're investing for your retirement. So there's a different time horizon with that. And everybody that walks in the door here at McPherson Financial Group, we've already de-risked their portfolio. So when they first came in, they might have had an accumulation allocation where they're being aggressive on some of the money and they're really taking risk. We've moved a lot of that off the table because now we're income planning. Now we're doing that retirement income stream. So volatility during income can be an enemy of your portfolio. So we want to remove as much of that as we can. And we've already done that. So we've already had those discussions. So usually their portfolios have already a lot lower risk tolerance than the regular market itself. So the market's down 10%. Almost all of our clients that had called, like Luke was saying, were only down 3 or 4%. However, they were still nervous because it was down some. And it's funny, Luke and I talk about this. Every time we start having those few clients that'll call like that, it's always usually means that we're at the bottom. So we're trying to help them walk through that, because we're like, can you just wait a little bit more? Because it looks like all the data's coming in that, we're rebounding, we're coming off the bottoms here. And if we get you out now, you're going to miss some of that bounce back, and we don't want you to miss that. So it's really just talking our clients through that experience, making sure they are reminded of why we're doing what we're doing and how everything works together, because they've got that money that hasn't gone down. They've got that money that's still making them interest and growing. It's just those aggressive part of that portfolio that's gotten hit. It's not all their dollars.
But there are some times when you want to sell, right? If you're, if you need something, if you need cash or have a big expense in the next, 3 to 6 months, your money shouldn't be in the market anyways, or you should have taken it out at the higher points, in December. So you need to be careful on big upcoming expenses that more than likely should not be in the stock market if you know you're going to need it. Another reason is for tax losses. Mm-hmm. There's losses on paper, then there's losses in your account. So there's dollar losses and there's paper losses. So with some of our high net worth clients here at McPherson Financial Group, we have a strategy where we're harvesting losses within the S&P 500. So if you just own the S&P 500 and say you own the Vanguard S&P 500 and it goes up, you don't capture any losses, you don't capture any gains unless you sell. Well, within the S&P 500, there's 11 different sectors of the market. Not all of them go up together. So last year, the S&P was up 26%, but not every sector was up, right? Energy was up a lot more. There were certain sectors that were even down last year. So if you can capture losses on paper for your tax return on the way up, it's a win-win for you. It's a win for your tax return.
Yeah, and that makes a huge difference, Mark, because I'll give an example. So we had a client come in. We don't have all of their assets, so we have some of their assets. They had another firm that was investing a lot of their assets, and they normally need about $150,000 a year of income. But last year, because of the other firm not being, they're not tax efficient, and they don't consider taxes on their trades, they had to pay income tax on $660,000. So it can make a big difference on how to sell stocks, mutual funds, bonds, all that. And watching that's what we do. We take tax into consideration before we sell things to make sure our clients not only are making money, but are being very tax efficient.
So with the clients that you serve, Luke, are they calling you? Are they a little panicked right now because of the market correction? Or is everybody that you help, are they pretty much emotionally level-headed?
Pretty much emotionally level-headed, but there's always a few that, get nervous. There's just some nervous Nellies out there. And what Art was mentioning, most of our clients, even though the market was down, 10 to 12%, their whole portfolio may be down 3 or 4. So even for them, that feels like a lot. And that's when we start having discussions of, okay, now's not the time potentially to readjust, depending on the markets, of course, but maybe in the future you shouldn't be this aggressive, right? Maybe we need to de-risk the portfolio even more, because a 3 to 4% correction when the market's down 10 to 12 is too much for you. And I think, and that's a win in my book, right? Down 3 to 4 when the market's down 10 to 12. Now, of course, every client's different, and every client has their own portfolios and, their own custom models that we build for them. But, it's a good time to think about, am I taking too much risk?
Right. And it's good to kind of have that level head to talk to. And that's the entire team at the McPherson Financial Group, 772-281-5223. And I know it's something that we talk about every week here on The Art of Money, and that's inflation. Analyst Richard Bernstein thinks the Fed has made a big error. He told Fox Business the only way to curb these soaring prices with inflation is to cause a recession, but the Fed is still employing policies that were years ago old.
Clearly, the economy is very different. The Fed has not adjusted. They've been very lily-livered, if one likes that term. And I think we're going to see a little more inflation because of that. I would say, if you think of an over-under, take the over on inflation right now.
So he says a combo of increased rates and profit slowing will cause a more unstable market. Do you agree, and what's the safeguard?
Well, the market hates uncertainty. So if the market is not certain that the Fed is going to move properly or move in a way that's going to benefit the economy, then of course the market's going to be bouncing around, more volatile. So what he's saying in this scenario is the Fed's trying to be careful. They're probably going to be slow in raising because they don't want to put the brakes on the economy. They don't want to dive into recession. So they're raising, but they're doing it with a tempered motion. Because they're doing that means we're going to still have some upside on inflation, because we actually are going to have prices increase again. Why money is cheap.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com. We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson. Florida Insurance License number A174725.
Today's show has been a work of art.